Welcome back to Silver Dispatch. I'm OG Peter, and I need you to stop whatever you're doing right now, because this particular weekend is not ordinary. Markets do not come with warning labels. They do not schedule their most consequential moments for your convenience. They simply move, quietly, methodically, and by the time most people realize something has shifted, the shift has already been priced in. This is one of those weekends where paying attention is not optional if you take your financial future seriously. Here is where we stand. Silver closed this past Friday, the 8th of May 2026, at approximately $81 per ounce. 12 months ago, that same metal sat below $30. Think about what that actually means. This is not a commodity experiencing a seasonal uptick. This is not a speculative spike driven by a single headline. What we are witnessing is a structural repricing, a fundamental revaluation of silver's role in the global economy, and the forces behind it are not slowing down. But here's the question serious investors should be sitting with this weekend. Not, is silver expensive right now? That is the wrong question entirely. The right question is this: are the conditions that drove silver from $32 to $81 still intact? And beyond that, are new forces now entering the equation that could make this week's market open unlike any other in recent memory? This is where it gets interesting, because the answer to both of those questions is yes. And the reasoning behind that answer is what I want to walk you through today. Clearly, factually, and without the breathless hype that passes for financial analysis on most platforms. Let me give you the foundation first, because without it, nothing else I'm about to say will make full sense. Silver is not simply a precious metal. It is simultaneously an industrial input, a monetary asset, and increasingly a strategic resource. According to data from the Silver Institute's most recent annual market survey, the world has now consumed more silver than it has produced for 6 consecutive years. Every single year since 2021, global demand has outpaced global mine supply. The cumulative shortfall across that period approaches 800 million ounces, roughly the equivalent of an entire year of worldwide production, quietly drawn down from above-ground stockpiles. And yet the supply side cannot simply respond. More than 70% of silver extracted globally comes as a secondary output from copper, zinc, and lead mining operations. Silver producers do not increase output because silver prices rise. They respond to base metal economics, permitting timelines and capital cycles that play out over a decade, not a quarter. Slow supply, accelerating demand. That is the geological and economic bedrock beneath everything happening this weekend. And on top of that bedrock, the calendar has arranged something extraordinary. Here's a fact. Not a forecast, not a theory, not an opinion. A simple, verifiable fact of the global trading calendar. China observed a national holiday on Thursday and Friday of last week. The Shanghai Futures Exchange was closed for 48 consecutive hours. Why does that matter? Because Chinese industrial buyers represent the largest single community of physical silver demand on the planet. Solar manufacturers scaling up panel production, electric vehicle battery assemblers, consumer electronics producers. These are not speculative participants placing paper bets on price direction. These are buyers who require actual metal to keep actual production lines running. They were offline when silver moved from the low 70s to above $81. They did not participate in that move. They did not react to the United States non-farm payrolls report, which arrived at nearly double market consensus, 115,000 jobs against an expectation of 62,000. They simply were not there. And on Sunday night at 8:00 Eastern Time, they return. Now here is what most financial commentary handles poorly. There is a structural difference, a genuinely important one, between markets that trade paper claims on metal and markets that require physical delivery of it. The COMEX exchange in New York is, by design, a paper market. That is a description, not a criticism. Its futures contracts represent standardized agreements to purchase 5,000 ounces of silver at a future date. Historically, well above 95% of those contracts are never settled by the delivery of a single ounce of physical metal. They are offset, rolled forward, or cash settled. The exchange performs a legitimate price discovery and risk management function, but it does not move metal. As of mid-April, registered COMEX inventory available for immediate delivery stood at approximately 76 million ounces. Against that, the total paper exposure represented in open interest approached 575 million ounces. The coverage ratio, meaning the proportion of paper claims that could realistically be honored in physical metal, sat at roughly 13%. The Shanghai Futures Exchange operates under fundamentally different conditions. A Chinese solar manufacturer cannot substitute a cash settlement notice for the silver paste applied across a photovoltaic cell. Production schedules do not negotiate with paper markets. When Chinese industrial buyers return Sunday night, their first orders will be physical delivery orders, placed with urgency, because urgency is the nature of industrial procurement. So ask yourself this: What happens when the world's most structurally significant group of physical buyers re-enters a market that moved $9 per ounce in their absence, and does so within 12 hours of two unresolved macro catalysts landing simultaneously? That is the setup. And understanding it fully requires understanding what those two catalysts actually are. Before I walk you through the two catalysts that will define Monday morning's open, I want to say something directly to the Silver Dispatch community. If this kind of structured analysis, the kind that separates confirmed facts from reported developments from genuine unknowns, is valuable to you, make sure you are subscribed right now. The investors who navigate moments like this successfully are not the ones who react fastest after the bell rings. They are the ones who understood the architecture before Sunday night. Subscribe. Stay in the conversation, because what comes next is where most analysis gets it wrong. The first catalyst is geopolitical. Reports confirmed Friday that the current U.S. administration delivered a diplomatic framework to Iran through Pakistani intermediaries aimed at de-escalating the ongoing Strait of Hormuz conflict. That waterway carries approximately 14 million barrels of oil per day. Iranian forces have been contesting it for nearly 10 weeks. Brent crude closed Friday near $101 per barrel. Tehran confirmed it was reviewing the proposal and expected to respond within 48 hours, a window that sits directly on top of the Shanghai Futures Exchange reopening. Consider what each resolution pathway actually means, with intellectual honesty rather than wishful thinking. If Iran signals movement toward a ceasefire, energy markets would likely price out a significant portion of the geopolitical risk premium embedded in that $101 oil price. Lower oil translates to reduced inflationary pressure. Reduced inflation gives the Federal Reserve more room to consider rate adjustments. Treasury yields could fall. The dollar could soften. Silver, which is priced in dollars and historically moves inversely with real interest rates, would receive a monetary tailwind layered directly on top of the existing physical demand floor. The net speculative positioning in paper silver markets is currently short. A macro tailwind would force rapid short covering. However, if talks collapse publicly, the inverse plays out. Oil prices spike. Inflation expectations harden. The Federal Reserve's justification for any rate relief disappears. Paper silver faces macro headwinds. But here is the nuance that distinguishes careful analysis from binary thinking. Physical demand does not evaporate in that scenario. Industrial buyers still need metal. Defense procurement, which draws on silver for guidance systems, radar components, and communications infrastructure, historically accelerates in periods of elevated geopolitical tension. The structural deficit does not pause for geopolitical events. The second catalyst is the April Consumer Price Index report, releasing Monday at 8:30 Eastern Time, approximately 25 minutes before COMEX opens. Market consensus expects a year-over-year reading near 3.2%. A softer-than-expected print opens the door for rate relief expectations. A hotter-than-expected reading slams it shut. This is where it gets analytically interesting. These two catalysts are not independent. A Hormuz resolution would itself be deflationary, reducing energy costs, easing CPI pressure, and potentially making a soft inflation print both more likely and more meaningful to Federal Reserve policy. In the most favorable scenario, they reinforce each other. The investor who understands that both outcomes remain live, and has positioned with appropriate humility, is the investor who tends to remain in the game after the dust settles. There is one real-time signal in this market that most retail investors either overlook or misunderstand, and right now it is communicating something important. I want to talk about physical premiums. The $81 spot price you see quoted on financial platforms is derived from COMEX futures. It represents the price of a paper contract, not the cost of acquiring a silver bar or coin sitting in a dealer's inventory, awaiting immediate delivery. When physical demand exceeds what refiners, mints, and distributors can supply at pace, dealers are forced to pay above spot to source inventory, and that cost passes directly to buyers. As of this weekend, American Silver Eagles are reportedly trading at $8 to $12 above spot at retail dealers, depending on volume and relationship. 100-ounce bars carry narrower premiums but remain meaningfully above historical norms. The exchange for physical spread on COMEX, which measures the gap between futures pricing and the cost of immediate physical delivery, reportedly expanded from a historical average near 0.25 to over $1.10 per ounce during periods of acute tightness earlier this year. The Shanghai Futures Exchange has at various points this year traded at premiums of 10 to 13% above Western benchmark prices. These are not minor distortions. They are the market communicating in the only language that cannot be fabricated, that the real cost of acquiring actual metal is higher than the paper price suggests. Now let me give you the longer context, because this weekend exists inside a larger narrative arc. Solar photovoltaic technology is currently the single largest industrial consumer of silver globally. The 2025 World Silver Survey projects that solar panels alone will consume over 230 million ounces in 2026. The highest efficiency panel designs now proliferating, requiring metallization on both faces of the cell, are more silver-intensive than prior generations, not less. The electric vehicle industry is projected to surpass internal combustion vehicles as the primary automotive source of silver demand by 2027. Artificial intelligence data center construction is accelerating demand for silver-plated connectors and thermal interface materials that have no commercially viable substitutes at current performance thresholds. And in 2025, the U.S. Department of the Interior formally added silver to the nation's critical minerals list, placing it alongside copper and rare earth elements as strategically significant to American industrial and defense capacity. Bank of America's most recent commodities analysis targets silver between $135 and $309 per ounce over the medium term. Citigroup has published targets in the $150 to $170 range. These are institutional research desks with resources and accountability, not fringe newsletters. What I'm watching Sunday night at $8 Eastern is the Shanghai opening price relative to Friday's New York close. That gap will immediately signal whether Chinese buyers are returning with urgency or hesitation. Drop your answer in the comments right now. What premiums are you actually seeing at your local dealer or on the platforms you use? That ground-level data from real participants across different cities and countries is something no algorithm can replicate. I'm OG Peter. This is Silver Dispatch. This content is for education and discussion only, not personal financial advice. Do your own research, consult qualified professionals, and make decisions with your own money and your own risk tolerance. I'll see you Monday.